Hey everyone, Brian Bogner and Greg Towner here. We got a special report for you with this video update. We're going to be talking a little bit about emotions. And why is this important? Simply because, hey, there's a lot emotionally going on right now. We're about to start another presidential campaign. We know people get pretty charged up on politics and all kinds of things. And sometimes we can relate a lot of these macro events going on around the world into our investing, and our emotions get involved. Let's be honest, when we've got money involved, our emotions tend to get tied to that here. And as we're going to talk through today, as an investor, that can be very dangerous. So let's go ahead and get started here. All righty. Take it away, Greg.
Yeah, thanks, Brian. I mean, I know both of us throughout the course of our careers have seen how dangerous, emotional investing mistakes can damage people. That's why we really truly believe it's the greatest obstacle to, achieving your financial goals. It's not, what stocks you pick or even what the economy is doing or all those things that are certainly important, but they can be, overshadowed by critical mistakes at the worst possible time. We created this chart about 2 years ago, and this is a look at the S&P 500 from 2004 to about 2017. And what we did here, Brian, is we just kind of put in some thoughts that a lot of investors might have had at particular times, investing mistakes. So, we can see there, starting on the left, when the market was starting to take off after the tech bubble, and everybody started to get excited. They hadn't cared about stocks in a couple of years. Now all of a sudden they were switching on CNBC, and they were, getting out of flipping houses, and they were, getting into stocks. And inevitably, right at the top of the market, everybody was all juiced up about stocks, checking their account balance a couple times a day, that sort of thing. And then once the market started to roll over, you had a lot of these typical emotions where, they say, oh, well, if I could just get back to even, I'll sell. That kind of brings into technical analysis we talk about. Or as it started to really fall apart, they say, oh, how could I have been so dumb? And then they go to cash, and it just, those people that were looking at their statement online are not even looking at the ones that come in the mail anymore. And then perhaps worst of all is a lot of those people that sold. We hear this all the time when new clients come to us saying, I'm sorry, I hate to admit this, but I haven't been invested in 10 years since I bailed out. And they blame the Fed, or they blame, they couldn't have run this long, or what have you. And so they had all these, excuses, but, emotional thoughts on the way up that prevented them from getting back in. As late as a couple of years ago, during the election, we heard a lot of people say, well, I'll wait till after the election. And then, and then they say, oh, well, now I can't get in because I don't like that person. They let politics get involved. And so there's just, this is just a small sample of some of the things that go through investors' minds over time and cause some critical errors that make us believe they are the biggest obstacle.
Right. Yeah. And just going back to that real quick too, when you look here again, this lends to irrational decisions, right? And so when our emotions get involved, we basically we do the wrong things at the wrong time, and that's what happens. And I think that's what you're going to be talking a little bit about here as well.
That's right. A lot of people think, oh, well, a cure for that is just passive index funds. They've become extremely popular, and they certainly have their benefits. We use them in a lot of our strategies, but that doesn't make you immune to making mistakes. We looked at this study here, a 10-year study. So each of these categories, value, growth, and S&P, looks at the actual Vanguard index mutual fund. So it's an actual index fund. So starting with the value column, the investors in that fund only returned about 2% over that 10-year period, annualized, whereas the actual fund itself returned about 6%. So the people invested in that index fund only returned about a third of the actual fund itself. In the growth fund, they achieved about 70%, and in the S&P, they only achieved about half. So they were actually invested in the indexes, but they only got around half of the returns because of the emotional mistakes of getting in and getting out, and letting everything on that chart we showed get the best of them.
Yeah. So how do we prevent emotional investing mistakes, right? So here's 4 points. If you want to write these down, you can. But first thing you want to do is you want to follow a rules-based and disciplined investment process. And rules-based is what's going to keep your emotions out of making those decisions. Doesn't mean rules-based is always going to be the best trading decision or 100% profitable, but it's going to keep your emotions in check. And when you make a decision, there's going to be logic. It's not always going to be the right decision, but when you have logic backing it up, you're going to put probabilities a lot more in your favor. You're going to incorporate a risk management process right into your process where when things start going south, you've got some either stop loss levels or things like that to help you from participating in that long, painful down draw. Fourth point here is you got to have the patience to benefit from long-term returns. Returns we look at, the S&P's averaged 8% a year or 9% a year over this 30-year period. Well, that's the average. But that's not what the H return was every year. I mean, some returns, it might be up 30%. Next year, it might be down 20%. But if you have the patience to benefit long-term, that's where you get that nice average. And this one here that I love probably the most, turn off the TV, turn off CNBC. It's entertainment news. It is noise. And everything they're talking about is pure noise. And what really is affecting these big trends and these big moves in the market is not what's they're printing at that headline for that day. There's usually macro things that are happening that usually they don't start reporting on until it's too late. And you can look at the tech bubble, you can look at the housing bubble, you can look at all those things. Well, after the fact, they reported, this was happening. But during it, none of that was being talked about. Turn off the TV and avoid the noise. Here at Parallel, we have, for these very reasons, we've developed and refined an investment system. We call it QRLT. And I just want to go over that with you. Q stands for high quality. We primarily own high quality investments. Okay, so we do our research and make sure what we own is high quality. R stands for rules-based risk management, just what we talked about in the previous slide. We make sure we've got rules in place and a risk management process. L stands for liquid and low cost. This means that we want to make sure that what we own, we can either sell or get out of. It's always liquid, and then it's low cost as well. It's not costing us or hurting us on the transaction. And then we're always, always tax sensitive to make sure we're not doing things creating additional tax burden. So Parallel QRLT investment system.
I love this quote, Brian. This is from Benjamin Graham. He is a famous value investor and the mentor to Warren Buffett. It says the investor's chief problem and even his worst enemy is likely to be himself. Mm-hmm. And that really kind of sums up what we're talking about here today.
Absolutely.
And in summary, again, emotions, we truly believe are a huge obstacle to you achieving your financial success and goals. So making yourself aware of that and trying to figure out how to get around it is key. Passive investors make just as many errors as active, so that can't be ignored. And as Brian just talked about, there are definitely ways to help reduce those emotional investing mistakes. So as always, you know how to contact us. Thank you very much for your time, and we'll talk to you again soon.